Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some bulletin board hero stocks amongst private investors on Monday, July the 14th. And I'm starting off this week with some stinkers, I can say. The first one is Motive Television. Here, the problem with the shares is that we're sort of caught between deciding whether they're in a range or whether that's going to break down, etc., etc. Also, some erratic moves seen over the course of the past year, a couple of spikes towards 0.04 pence as well. But the current position is that it looks like there's been a bear trap rebound from below the former May support zone 0.015 pence, and we look to be back into a rising trend channel from May 2013. On that basis, one would be looking for a resumption of the range back towards 0.03 pence, and with that accompanied by the RSI breakthrough neutral 50, suggests that, and the higher volume on Friday as well in the stock suggested that we could also be back in the range. So slightly more encouraging there at Motive Television. Equally difficult is Quindell, of course, at the moment. I identified an obscure line of support from May last year running through around the 200 pence level. That looks to be around current levels, 180 to 190, rather than the 200 pence that it seemed to be before. We had a bit of a overshoot to the downside below 170, but it still looks as though the shares are trying to cling on despite the best efforts of rather high-profile bears at the moment. If you're not sure about the stock and don't want to be bottom fishing, then maybe you wait for an end-of-day close back above the 10-day moving average, currently at 205 pence, or even the 20-day moving average at 217 pence, which is also a May resistance line. The reason that it doesn't matter too much if you're late on the upside argument is, of course, the way that we're so far off the highs, the equivalent of 600 pence plus, that missing 20, 30p of the initial upside in order to avoid any potential collapse is not too much of an issue. Other stinkers to look out to the start of this week are GCM Resources, starting off with that one. Here we've had the near vertical spike. In fact, this was actually a chart of the week just ahead of the spike in June for the shares, which took them towards 30 pence. Chart of the week on zaxta.com. After that, there was a final bear trap flush out towards the 50-day moving average at 19 pence before the vertical move here today. The message at the moment, obviously, is that you'd have to be pretty brave to be chasing the stock higher, but there is an opportunity in terms of waiting for any weakness towards the May post-May resistance around 30 pence mark, maybe just a little lower than that 28 to 30 pence mark in terms of June resistance last month. And if we get down there, that might be a dip to buy into in order to try and capture the best case scenario target at the moment at the top of a rising trend channel from last year at 50 pence. Finishing off this selection with arguably the most difficult of the lot at the moment, and that's Mosman Oil and Gas. Here a horrible breakdown after a lower highs put in below 50 pence for July. Key reversal down to the downside to end last week, back towards the floor of a rising June price channel at 26 pence. I would say that at the moment the risk is that we'd actually go lower, maybe hit the 50-day moving average just under 20 pence, and that would be the sort of the safer place to go long, especially as that would sort of tie in with former resistance in May in the upper teens as well. So at this stage, towards 18, 19 pence looks to be the bottom fishing zone, and the only real positive at this stage would be that there's an RSI support line just below 50 pence, which may slow further breakdowns from current levels. That's it from me. More on spreadbetmagazine.com.